I would say overall the banking system is sound and resilient. We're not seeing the kind of liquidity pressures that we saw, a year ago in March of 2023. There are pockets of risk in the system. We do have banks that are more under stress than other banks. We're looking at things like what's the level of unrealized losses on the balance sheet from securities. We're looking at banks that have particular kinds of concentration in commercial real estate. So, for example, commercial real estate covers lots and lots of different sectors. The office commercial real estate sector is under stress more than other parts of the sector, and there's heterogeneity around the country. So we're just looking very carefully at banks that have heavy concentrations in office commercial real estate where there are significant expected price declines is another example. We're always worried about and think all the time about operational risk exposure. So, banks' exposure to cybersecurity risk is a big operational risk and one that is a constant kind of threat to the system that we have to be careful and monitor. So those are examples of some of the kinds of things on our minds now.
On the commercial real estate piece of it, is there like a time period when, once we've gotten through X year, we'll know we've made it through? Like, how are you thinking about that?
This is the kind of thing where it's likely to be a very slow-moving train as the financial sector and commercial real estate market move forward. Why is that? Well, commercial real estate properties refinance at a periodic cycle. Those are not all done in 1 year or 1 month. Those are being refinanced slowly over time. So over the next 2 to 3 years, we're going to see how properties deal with that refinancing in a higher interest rate environment than the extremely low interest rate environment they were operating in pre-2019. Some of those deals will keep penciling out just fine. Others of them will be worked out in ways that are not problematic for the banks that funded them because they have high levels of equity cushions. And other banks are going to see losses on those loans. So that will take some time to work through. And we're obviously operating in an environment in which for office commercial real estate, in general, this is a generalization, vacancy rates have increased or occupancy rates have lowered because of work from home. And so for some categories of office CRE, that means they're more exposed to risk.
Yeah, so you can't say for certain when we're through it.
It'll take some time.